Over the years, much has been written about how simple trading can be, yet it's not easy. Now that's just not a play on words, but it hammers home that the work you do to find your trades and manage risk and other variables that make up the act of trading is simple. Doing it consistently, though, it's another matter, and that's when not easy comes into play. The best way to learn is with live examples, and I want to focus on the term simple by using the US dollar CAD Forex pair and a swing trade scenario. And I want to show 4 simple trading tools: a simple pattern, a simple entry, a simple risk reduction, and a simple exit from a trade. Keep in mind, though, that the context that was taken into consideration was a steady uptrend in this Forex pair, 2 weeks in January of large momentum moves, and 10 weeks of the market in a pause. A simple channel was drawn on the daily chart once the lows and the highs were locked in, and could be used for anchoring and duplicating. There is nothing magical about channels, but they do tend to highlight the rhythm of the price action quite well. An interesting time is when the channel is broken with momentum, and those can offer some solid trading opportunities if you know how to trade them. Now, channels can highlight trading ranges, trends, and even pullbacks. It's a pretty simple tool, and it has a lot of uses. Now, this channel, it showed more of a range in the action of the price with a slight upward slope. I think we could agree that the price action is making some pretty sloppy moves inside the channel, and nothing is really clear cut. In hindsight, though, yeah, we could have sold the top as we see in the middle of the chart. However, unless you're day trading on lower time frames, this price action is not conducive to a clear-cut trading opportunity, especially for me. There was a clear setup as shown with the orange circle, and I certainly could have moved my line so that the shadow broke it. However, consistency matters in trading, and I missed that trade. For me, with my setup, this was not a trade entry. Now the green circle, that's another matter. It's a reversal type candle, of course, but the highlight for me was that it probed below the bottom channel and was quickly rejected. Now, did it trigger sell orders and then quickly reject them, forcing traders to buy to exit and help form a strong bull body candle? Well, the details behind the scenes was not important, but this failure test was an entry for me into a long trade. As a matter of fact, I did not wait for the close of the candle, which is called front running, because location, context, and a sharp rejection was enough for me to risk on this trade. The stop was below the low of the entry candle, and I find setting stops on these types of plays pretty straightforward. Mean reversion trades, they're another matter, as setting stops on those setups come with their own sets of issues. Now, one easy way to cut risk is to take trading profits at 1R, 1 times your risk. In these range plays, I usually cut half of the position off, which will leave me with no risk on the trade. You can see on this chart where my position was reduced. Now, risk reduction and management is critical for your long-term trading success. Now, what had me trigger into this trade was an obvious reversal candle at a prime location in a market that's in an uptrend. What gets me out of this trade is an obvious reversal candle that shows up in the middle of a range that's seen some pretty sloppy price movement. The candle that gave me my risk reduction also closes as a candle with a small bare body and a long upper shadow, as pointed out in this trading chart. It was impossible to ignore that candle, and my stop was ramped up to just below the low. You can clearly see that I was taken out of this position, leaving me flat with 134 pips on the scale and 53 pips on the profit stop. Now, there are clues on charts, however, not every clue builds a case big enough to base a trade on. Not every move is playable, but at certain points on a chart, there is the possibility of the supply-demand imbalance being big enough to give us a playable move. Simple patterns that have been around since there have been price charts, showing up at certain points in a market, can offer the astute trader plays that are worth risking some of their bankroll on. It does not have to be complicated. It's not reinventing the wheel. It's using simple trading tools, as discussed, and what is shown to give a slight edge and getting the most out of it until the time comes to exit. Then just allow compounding to grow your account.